Good morning, everybody. This is already day 4 of our Risk and Regulatory Academy, which is dedicated to all the risk specialists across Europe. Actually, day 4 is fully dedicated to market risk topics. So we tried to think about the topics that are most important right now, and that would be most important also in your daily job. So basically, we decided to go for 3 topics dedicated to market risk. The first one, which is IRRBB, so interest rate risk in the banking book. We already saw the implementation during 2019, but on the other hand, I believe that the questions and let's say the discussions around that are not over. And as we have the COVID time right now and as unstable financial market, we keep coming back to at least a few detailed questions regarding this topic. The second presentation that we prepared for today is dedicated to FRTB, so the trading book this time, and the challenges that we face during the current time, but also the next year, when we should start at least presenting the information about the FRTB capital requirements. And last topic, this is the presentation about IBOR reform. I always recall the words of our British colleagues, Simon Brennan, who was already speaking over last days. He calls it the biggest change and the biggest challenge for the at least British banks. And I will try to discuss, let's say, the current status and let's say that the shape of the reform in different European countries. Let me also kindly introduce our guests, Thomas Lutztek and Alex Hanna. Thomas, Alex, could you please introduce yourself?
Yeah, thank you, Pavel. So my name is Thomas Lutztek. I'm a senior manager working for the Deloitte office in London, and there I'm covering mostly market risk projects for the investment banks here, mostly in London. And I have started with FRTB in 2015 already with a large implementation project there, leading the solution design, and since then have supported clients with FRTB topics. And then we'll hand over to Alex.
Thanks, Thomas. I'm Alex Chana. I'm working in the Paris of Deloitte Paris office. I have more than 15 years of experience. I have led several missions across Europe, but more specifically in France on IRBB topics. And yes, I will be presenting the new perspective to interest rate risk in the banking book today.
Okay, thank you very much. And just for completeness, my name is Paweł Spławski. I'm a partner in the Warsaw office of Deloitte. I'm responsible for the risk and regulatory services. And I will have the pleasure to, let's say, coordinate and run the whole event today for you. Okay, so before we go to the presentations and before we go to the discussion, I would like to ask Carolina to describe the main rules of the presentation and, let's say, housekeeping rules.
Yes, thank you, Paweł. So you see a chat box. Through that chat box, you can communicate with us. So please type your questions during the session anytime, and our panelists will read and respond. Only the organizers and the panelists can see what you type in the chat box, so the other participants will not see what you're asking or your comments. We're gonna have some poll questions. You will see them on the screen, and you can easily vote by choosing an option. These are anonymous also, and you will all see the results after a few seconds. So please vote and share your opinion with us by those polls. And as we are a lot of us here, around 300 people already, the audience is muted all the time, so please communicate us through the chat, as I mentioned before.
Thank you very much. Yes, the audience is muted, but on the other hand, we really count on your questions, because after each presentation, there will be time for asking the questions from the audience. So if you could please type them as, let's say, the interesting topics appear on the slides, and I will try to collect the most important questions and ask to our presenters today. So Alex, the floor is yours right now.
Thanks, Pavel. Hello, everybody. We'll begin this morning with the presentation of by giving you a new perspective on IRBB regulatory requirements. We'll begin by giving you first of all a background on the regulatory requirements concerning IRBB. Things started in 2004 with the publication of BCBS, a BCBS text concerning interest rate risk that was more concerning board and senior management oversight, and also policies and procedures to manage interest rate risk. We have also capital adequacy in that text, but it was more principles, no prescriptive rules. In 2006, we have a publication of technical specification from the CBS, and the CBS in that paper gave guidance on how to identify, monitor, and measure IRBB. And things really become serious in 2014 with an attempt from the EBA to include the interest risk into the Pillar 1, but that was not conclusive, and it ends up with a final publication of final standards of IRBB in 2016 and an EBA publication in 2018 of new framework for the IRBB with some prescriptive approach and prescriptive way to build the IRBB framework. The implementation date of those regulatory requirements was last year, end of June 2019. Let us see now what are the key takeaways from those regulatory requirements. That means we will move, in fact, to next slide. The supervisor publication, the supervisor latest publication on IRBB, it can be is structured, in fact, into three streams. The first stream is concerning the governance and the management of interest rate risk, and the second stream is more on IRBB measures, and the third stream is more on capital and capital adequacy for the IRBB. Concerning the governance and the governance around IRBB, we have some instruction from the supervisor concerning the inclusion of IRBB within the risk appetite and the risk profile. We have also some lines on the limits and the policies and procedures around the limits and the controls of IRBB. We have also some lines on the powers delegation with line of responsibility and accountability. For IRBB measures, there was a focus on the economic value and the earning-based measure. We have also focused on forward-looking approach with stress testing, reverse stress tests as well, and also modeling, ILM modeling and assumptions, talking more about behavioral model, non-maturity deposit, for example, modeling. And going to the third streams, we have then the paper, the latest paper gave some guidance on how to assess the capital adequacy for IRBB, and it develops, in fact, a method based on the forward-looking approach. That is including stress testing, simulation, balance sheet projection. The supervisor introduced some stress test scenarios, to be precise, 6 stress test shocks: the parallel shock up, parallel shock down, and the steepener shock, the flattener as well, the short heights shock up, and the short heights shock down. Those regulatory requirements has been implemented by banks. Talking about Western Europe banks, they have passed the last, I say, 3-4 years to implement those regulatory requirements. And by implementing those regulatory requirements, they have faced many challenges that we will go over now. The main challenge was dealing with the new IRBB measures, especially economic value, and as well forward-looking, with new demands on simulation, balance sheet projection, and dynamic simulation as well. And the 6 interest rate shock scenarios to implement. It was a huge challenge, and it was a huge challenge for first the IT system, because many of the ALM solution in place in banks at that time were not able to perform in a reasonable time frame those projections. Main banks then spend the last 3 years to in upgrading their IT solutions. And what we see also was another challenge faced by the bank is also the risk management framework that need to be rebuilt. You have to recall that before ALM was a little bit in between the risk department and the trading department, and in many banks it was more close, in fact, to front office department. And with the new regulatory requirements, many banks has to build and set up a risk ILM that is with an objective, in fact, to control what ALM department was doing. That was quite new, and it was quite a challenge, because banks need, in fact, to hire new people with new skills, IRBB skills. That was quite uncommon in the market. And the third challenge faced by bank is then the new target operating model for the ALM functions. With those new requirements in terms of dynamic analysis, meaning that including new future sales, and ALM department need to cooperate more with other departments like the sales, like the management control, and also the risk. And that is a change, in fact, from what was done before. LM also is therefore, and we will see that in the next slide, was more involved in bank strategy, and that is a change, in fact, on the processes, on also the target operating model, and that was quite a challenge to find, in fact, the good way to organize all that. I have the example of banks who decided, in fact, to build, to integrate, to have a joint, in fact, functioning between ILM and management control. We'll focus. We have now a quick focus on the capital adequacy for IRBB. That is the capital adequacy process is called the ICAP, and it is within the pillar 2. And it's not only for IRBB, in the ICAP we have also credit risk and market risk component, but IRBB components represent close to 7, in average, I will say, close to 7 to 11% of the capital. The ECB indicates that the main challenge faced by bank in computing the capital adequacy for IRBB is the measures, the measure to use. The supervisor gave instructions on which measure to use to assess that capital, and they ask banks, in fact, to use both, and it's important, both the economic value and the earning-based measure, and that was quite a challenge for many banks to use the both measure to capture the capital necessary for IRBB. The second issue faced by main banks was the relationship between normative and economic perspective within ICAP, knowing that the normative perspective is, in fact, the multi-year assessment of the bank capacity to manage, in fact, the at least 3 years of activity with the current capital. And the economics perspective is more, in fact, 1 year recent stress test on capital. And in many banks, and we will see that also in different survey performed by either the ECB and also Deloitte, that many banks do not build a relationship between those two perspectives within the ICAP. Let us see now, have a look on the ECB survey concerning the ICAP. That is next page, next slide. The ECB released last summer the result of the survey they have performed on ICAP that was concerning 37 financial institutions, mostly GCBs, and it was based on the ICAP package. ICAP packages submitted in April 2019. The main results we will see is quite interesting. Is what are the risks considered by GCBs, in fact, in Europe for the ICAP and then for the IRBB. And if you look into the table presented here, you will see that in average, three subcategories of risk are considered for IRBB, and the main one, in fact, are the gap risk, basis risk, and the option risk. Option risk. That is quite a standard. is what we are seeing in many banks. In fact, is the minimum of minimum number of risk category we see for IRBB. And also on the graph below is the ECB give, in fact, the relationship, the integration of economic perspective into the normative perspective. We see that out of 37 banks, only 4 banks, in fact, is doing so, meaning that is too small, meaning that most of the banks do not are dealing economic perspective and normative perspective separately within the ICAP. The second set of results in the next slide is concerning more IRBB measures. What we see that is most of the banks is trying, in fact, to use combination of the both of EV measures and earning measures. We have then most of the banks using a combination of the both, and many banks are using EV measure, even if it's is a challenge, and fewer banks are only using earning measures. In the next graph, what we see clearly is that for the majority of banks, they use scenario analysis and statistical model, and 1/3 of the banks are using supervisory outlier test to capture the capital necessary for IRBB. And there are some parts of bank that is still managing IRBB within the market risk, but is a small part. But it's quite interesting to see that even on GCB, some are still considering the IRBB as a part of market risk. We have now finished with with the feedbacks on the regulatory requirements. We'll now see that the ALM practices over the past 5 years have evolved, not only due to regulatory requirements, but also because of market conditions, and specifically because of the low interest rates. The low interest rates environment has stressed a lot the profitability of many European banks, and in this context, many banks, many financial institutions are looking for new homes of profitability, and that search for new homes of profitability is going through a lot of simulations, simulation with using many scenarios on interest rate risk. That's also go through a more accuracy in the indicators, in IRBB indicators, and greater implication of ALM within the bank strategy, and in particular within the sales process and the budget for forecasting. And in this context, the main I would say evaluation and challenge the banks have faced was concerning modeling, ALM modeling, to have more accuracy, to have more accuracy in the indicators they have, in fact, to be able to capture more precisely the behavior of clients, the behavior of client that is changing a lot over the past 10 years, I would say, with the evolution of technology. Clients are managing more dynamically their different accounts on their loans, and because of that, ALM department and banks need, in fact, to be able, in fact, to better understand customers, clients, and to be able to better predict their next moves. Behavior model was then a key challenge for many banks. And besides behavioral models, we have also all conditional cash flow projections. We have also another challenge when was to be able, in fact, to project the balance sheet, to have not only a short-term view, but a mid-term and long-term view. And for that, we need, in fact, to be able to project the profitability over 3 years, over 5 years, and the dynamic balance sheet and net interest income projection is something that is now very a key element on in the ILM department and in the ILM indicators. And the third element is the data quality. That is, the basement of all of everything. To be able to have something accurate, to be able to have good projection, you need to have data quality, and that was a really big challenge, and is still a big challenge for many banks. Giving a quick view on what is going on in Western Europe banks, I can say that data quality is still a challenge, and many banks are still facing a lot of data quality issue, and also the ability, in fact, to perform dynamic balance sheet and net interest income projections is still a functionality that many banks are still building. Before closing that perspectives on IRBB, we quickly go through the Deloitte survey performed in Central and Eastern Europe concerning banks in Poland, Hungary, Serbia, Macedonia, and 33 banks were concerned. The answer to 53 open questions around ALM, and the subcategory of those banks was going from category 1 to category 6. The survey was around as you can expect it, around governance and IRBB measures. We'll see that in the next slide. Concerning governance and mainly balance sheet forecast and net interest income projections. You have in the table the implication of the different bank department within the balance sheet projection, and what we can see is clearly that for market scenarios, for example, for market scenarios, interest rate risk scenarios, and even liquidity risk scenarios, ALM department are very involved with the chief economist. We have also in some banks some involvement of the finance, but I think for finance, within finance is more management control department that is about. And what is quite surprising is to see that for balance sheet development concerning scenarios, volumes, concerning also margins and spreads, and also prepayments, ALM department is not very involved in Central and Eastern Europe, and that is quite surprising comparing to Western Europe. To Western Europe, ALM department is clearly is clearly playing the major role in the balance sheet forecast with the management control. They are the two departments playing the major roles within all balance sheet projection, I will say. Let's move, in fact, to IRBB IRBB measures. What the survey is telling us first is that net interest income simulation is performed by almost all banks. Economic value of equity is used also by almost all banks, but I think it's more due to the regulatory requirements concerning the supervised outlier test. That is where there are prescription to use, in fact, economic value to compute data indicators. We see also that traditional ones are still used by many banks: BPV, VAR, and gap, static gap and dynamic gaps. In the next slides, we are still talking about IRBB measures. We can see that static balance sheet is still very used for quite nearly all banks are still using static balance sheet. Dynamic balance sheet is less used. I say half of the banks. And cash flow modeling, concerning cash flow modeling, optionalities are not completely captured at this stage. Half of the bank are using unconditional cash flow modeling, when 20 banks out of 33 are trying to include optionalities within the cash flow modeling. And concerning governance on the whole of ILM units within banks, what we can see in the table presented is that for most of the banks, ALM departments is reporting to the CFO in most of the case, reporting to the CFO, and is within then the finance department, finance or treasury departments, but they are all reporting to the CFOs, and it's quite a standard even in Western Europe. The dependence within the treasury is quite surprising, but is something we can see. And we see that for some banks, they have a direct dependence to the CEO and also to the CRO. We have just finished with that perspective on IRBB. What we can say to close that perspective is that ILM department, which is who is managing the IRBB, has evolved a lot over the past 5 years. Firstly, due to regulatory requirements, with the need, in fact, to implement new regulatory requirements such as economic value, simulation, balance sheet, forecast. And that change also is due to the market conditions that demand, in fact, to be more precise, to be able, in fact, to capture precisely what is going on, and then to be able, in fact, to have better behavioral models, and also to better internally price, in fact, the funding. I'm talking more about the FTP, for example. We have seen that in many banks, FTP computation and assessment has evolved a lot, and from something that was really not precise in 10 years ago, we have now in many banks FTP that is including many aspects of IRBB. I'm talking about optional risk, I'm talking about basis risk, I'm talking about also the gap risk, and they are all included now in many FTP framework. I will now give the room to Thomas for FRTB.
Yes, before we go to Thomas, let me just scan the questions and share it with you.
Okay, good.
We have a few of them. So let me start with the most general one. The first general question is, let's say, perhaps a question and your comments about, let's say, how comfortable banks feel right now with the IRRBB, and what main challenges and what, let's say, main areas of work are still taking place. You were mentioning that on the previous slide, but could you please, summarize that and put the most important elements?
Yes, concerning IRBB regulatory requirements, for many banks, we'll talk about for Western Europe banks. I would say IRBB regulatory requirements have been implemented for by many banks. Many banks have implemented quite almost the regulatory requirements, but there are still some that are still pending or still, I would say, under development, on development, and it's the most challenging one. That is simulation, be able, in fact, to perform dynamic projection of the balance sheet, not only a static projection, meaning to be able, in fact, to integrate, to have a view on the future sales, future volumes, and to be able, in fact, to adapt the cash flow modeling to interest rate environment that is forecasted. And that is really still the big challenge for many banks, and to be able to do all that in a reasonable time frame, and that's really the key challenge for many of them.
Mm-hmm. When we speak about models, actually we received a few questions dedicated strictly to this area. Let's say, what kind of, let's say, models, what are kind of techniques do you think are most promising, and let's say what currently is being developed in this area, and what is, let's say, perceived as the, let's say, solution for the problems you mentioned?
Concerning modeling, what we see is banks are going for more complex and sophisticated model to be able, in fact, to capture all the risk components on the specificities of their environment, and but we are still seeing more statistical model. But we know that some exploration are made by some banks, in fact, to use machine learning models to be able, in fact, to capture, to see if by using machine learning they can have something more precise. But the issue with machine learning is always the explanation is always to be able, in fact, to explain to a regulator or to the risk management department how to explain the results out of the model.
Okay, thank you very much. And one more question regarding, let's say, the ALM role, and in particular, the question referred to transfer pricing. So what, in your opinion, could be the role of the transfer pricing system in the whole IRRBB, so managing the interest rate risk in the banking book? Did you see, let's say, the impact of the changes, I mean, the regulatory requirements on the FTP system?
There is concerning the regulatory requirements, there is what the regulator is saying concerning FTP is to make sure that you have an FTP framework, something that is efficient, but it's not giving you guidance on how on which measure to use, in fact, to compute that FTP. And the FTP in most I would say most successful banks is very used and is adapted to the market condition, is adapted also to the complexity. And what we are seeing now is an FTP that is in line with the IRBB the IRBB framework. I don't know if I've answered to the question or is still some.
Thank you very much. Thank you very much. And actually, we have two more technical questions. So the first one refers to expected date of publication for the RTSs regarding the net interest income and the economic measures, because yes, that's true that EBA declared that it should be published and it should be, let's say, covered in details by additional papers on one hand. On the other hand, the date was postponed because initially it was expected during 2020. What I know right now is that the date was postponed for the 21. I didn't manage to find, let's say, any detailed expected date when those technical documents, technical standards will be published. And the second one is, let's say, extent of proportionality that should be used in the managing of the interest rate risk in connection to the less significant institutions, less significant banks. Actually, what I saw during, let's say, the implementation projects for IRRBB is that the regulator, the EBA, tried to, I would say, combine two guidelines which were issued during 2018. So basically, the first one regarding IRRBB and the second one regarding the ICAP. Yeah, exactly, as you mentioned. And what is clearly defined in, let's say, IRRBB guidelines is this how this connection works. So how does the ICAP classification affect the requirements for the implementation challenges and for the for the necessary elements of the IRRBB. And basically it's clearly defined starting, let's say, from the most requirements for the highest category banks, going to the lowest category banks and lowest requirements. However, I would also say that, especially what I saw across different Central European countries, is that after that, let's say, the level of requirements by the local regulator sometimes may differ. So sometimes, let's say, those less significant banks may have even less requirements, but it's, let's say, the regulatory practice, not the rule implemented by the EBA guidelines. So I hope it addresses the questions. Let me just quickly check whether we have anything in addition. And basically, I think we are done with the questions. So right now we can jump to Thomas and to the issue of FRTB.
Okay.
Thank you very much.
Okay, thank you, Pavel and Alex. So now let's move from the banking book to the trading book. So on the trading side, the regulation is FRTB. You can keep the previous slide. So the regulation is FRTB. And to give you like a background on the scope for this, so we will focus here on the standardized approach because that's sort of most aligned with the audience. Beyond the standardized approach, there's also the internal model approach and also derogation option, like for banks with a smaller trading books. But we can have a follow-up conversation on that one. But for this talk, it's like really the standardized approach. A second focus point is basically predominantly focus on challenges. So we won't like explain how it's set up for FRTB, but really about the challenges to go live, what we have experienced there in the market. And in terms of structure on the talk, I will first start with a survey. Then we give like our kind of view and approach to do that. And finally, we would provide a kind of case study and example. So let's start with the survey. So we conducted in 2019 and among like clients from mostly Northern Europe about what are the challenges to get ready for the FRTB standardized approach. So which is then here, yeah. So we ask basically what are the main challenges. And the biggest seems to be the clean and consistent static data for bucketing purposes. Like, for example, say you have a company, Apple, and you might put it into telecoms, you might put it into technology or consumer goods. So there is always some question how to do that, and we always see kind of data issues related to that. Then to a minor extent, you have like mapping instruments to risk factors and also some technical challenges, mostly about index decomposition. So if banks have indices, and the others like DSC calculation or the components seem to be a less kind of issue for banks. And what should be also mentioned, so there's a ECB survey that found basically that still 15% of the smaller or medium-sized bank have just made a small or negligible progress. But on the other hand, then 85% are already started and are more advanced on that one. There's another challenge, what we can see on the next slide. So this is also a topic for especially small or medium-sized banks. So in terms of the internal risk transfer, when you transfer risk from the banking book to the trading book or vice versa. And the other top issues are the documentation of the strategies or to process to get from the supervisory approval. So this has initially introduced due to the fact that in the financial crisis, like 10 years or 12 years ago, there has been banks sell a lot of CDOs or such products in their trading book, and they suffered losses, and so they moved them basically to the banking book, so that they don't have to account for losses. And for that, they have introduced this kind of boundary to make it to make banks avoid basically just moving it for accounting purposes. And what's also important here is, and that for the larger banks which have like large trading or trading only operations, this is less of an issue because they mostly have their trading book. But for smaller banks, they more use the trading book, like for hedging the banking book. So it's for smaller banks kind of proportionally bigger issue, this internal risk transfer. So these two are basically these two top questions here, basically about regulatory driven. But going beyond that, there's also kind of business impact of this regulation, because it's expected that the capital for FRTB under this rules might increase or at least change, and so there will be seen some business impact. And so the first question we ask is whether banks have done already some optimization within the rules. And in this survey, around a quarter of the banks have done already some optimization, but the majority haven't done yet. We can say from our experience, so when we go to clients, so we have our some calculator, and this when we run it, it not just produces a number, but also produces some kind of output where there is like hedges that don't work, or some the biggest driver and things like that. And so we really can read from that what are the optimize, where you can get optimization from the model. So we basically have some kind of like ranking, and there you immediately, it really pops up when there is some kind of mismatch that you can optimize. So this is like some quick wins that can be gained here. And the other question we ask about, so the capital is produced, so how does the regulator see it? And Quarter again thinks they are fine. The half of the respondents, they didn't have a view yet of what the regulator sees. Interesting, there's some of the banks, they also think that the regulators will push them to do the internal model approach. So that is what we got in this survey. And now in the next slide, we have some questions for you that you can ask. So how far are you in terms of FRTB readiness? So please answer. So either fully operational, and then you can produce capital numbers, but still some work to do. In progress, but expected to be ready before the deadline. Progress with challenges to be ready before deadline, and not started. Okay, we have some results already. So let's see. Oh, okay. So that's interesting. So more than half of the respondents have not started, and so we also, so for the just a few are like really fully operational. Okay, so that's a interesting insight here. Yeah, that's similar like to the IRBB survey. that we saw. And okay, so that's an interesting insight. So then let's move like to the next slide. So now I talk about where we see like what's required from our point of view for the readiness for the CRR2, and then our holistic approach to do that. So basically the date, the reporting date, so for CRR is not so far away, and so producing correct and valid numbers and having a good operating model is a key priority. What we see basically, and the timeline is has been moved recently due to COVID. So it's now the 30th of September 2021. So that's in less than 10 months. So there you need to submit numbers, and we saw that most banks can produce the capital numbers. So this is a little bit different to the survey, but from what we have seen, it was that most banks can produce these numbers, but it's still about testing and validation, because the numbers that you submit need to be correct. Then the second bit is the analysis, because you want to understand the numbers. And the third thing is basically the operating model. So now let's look at the lower left box. No, the previous slide. The previous slide. Yeah, thank you. So what we see like in the lower left box, so the testing and validation. What's typically done at client, we see that different data sources like need to be reconciled. Like clients might get ratings or something from different system for the same kind of risk factor, and need to then that this is all aligned. And the other thing is that the calculator itself is correct. So there's typically we see benchmarking against the quiz calculator, and we also go to the client typically and run our calculator and check where there are difference. And then we also like we have run this against several clients, and there's several choices to be made, and this is all reflected in that. And then from that there's like you get a kind of report, what are your data issues and how to remediate it. The second bit is the desk by desk capital analysis. So that's not really required from a regulatory perspective, but we see especially in our clients that there's like mostly where our projects are mostly driven from the front office. So they really want to understand how the number is produced. So what are the key risk drivers? So how can you drill down? And it's not just about producing one regulatory number for the regulator, but really the business lines want to know how the data has been produced. Why is it like that? Why is my capital doubling? And what drives that basically? Can I do something about it? Is what they want to understand. And the third bit is basically the target operating model. So it's not, so the first step is really to get to compute some numbers, but then we saw there's a lot of operational issues to get it running. So especially about data, there needs to be like controls or service level agreements to really get this running, because we saw too many data issues. And also there's some kind of planning involved. So what are your resource requirements? So typical topics from the target operating model. And then in the next slide, we show our approach. So these three things typically can't be done in a siloed approach. So they really need to be done like in holistic approach. So to give you an example, when we we see that we have done this, like for say we have been with our team like for 8 banks or something like that. So every time we go to a bank, so they have a business requirement that if they don't have data for a particular product or risk type, then they put it into the other bucket. So the other bucket is like a kind of default bucket where you can put your risk factor if you don't have data, but it's like punitive in terms of capital. So they always have this kind of business requirement that if there's no data, then put it into the other bucket. So that's not really a business requirement. So what we do, that we change this basically, and it's going to be that if there is a data issue, then somebody is going basically to look at the data issue and resolve it, either get the data, because it really has a capital impact. So that's really relevant here. And yeah, so that's kind of drives mostly the business requirement, and it's all about data quality here. And so all of these, and then the target operating model needs to decide like what kind of, due to this data quality issues, what ongoing testing and validation or controls you need to run, and also how your capital analysis needs to look like. And conversely, the capital analysis tells you basically how much you have, what are your capital impacts, and then how is your business line really, can it operate like that, or does it need to be changed? And so this is then important input to the target operating model. So to summarize, basically, data quality is really the key issues, and to address it, so all these 3 elements here need to be done in parallel or together. So then let's give you some case study. The next slide. So case study and capital allocation. So when we come to a client, what we see typically is like crude first pass implementation. So getting the numbers, because it's like already in the rules text in the CRR2, you get you can write a calculator for that. But then it's according rules, but it has some issues. So the first one is basically you aggregate just by the sensitivities by risk factor, but then you don't have really an understanding of how it's composed and what's driving it. And what we propose typically is to put it as granular as possible, so at trade level, so that people can understand or analyze really. And then the second thing is double looping through all the risk factor. And so that's if you aggregate like in the text, in the regulatory text, there's a lot of overhead computation, and we have like a simplification for that. So we just do a single loop. So this is kind of quadratic speed up, and that's quite important if you want to compute the numbers. It's really improves the speed. Then what you also see, when the data is aggregated, you use some correlation aggregation, and every time you compute, you have to produce the same basically. So you do a lot of redundant calculations, whereas we would produce additive contributions. So what we can really do is split down the capital charge into very granular components, and then we can aggregate it using pivot tables. So we don't need to run this complex computation every time. And so this is a kind of a good operational advantage here. And the other thing is they really just compute the final capital charge. But then the next step is really to disaggregate the number so that you can pivot and analyze them. So what kind of impact will that have? So if you have the crude implementation, you have like increased computation time. So each time you want to run some analysis, it might take a minute or so rather than like seconds. So it really takes some time, especially for equities or credit. And then it's also difficult to really drill down. You might get one number, but you have very different stakeholders, and they really want to know like how your data or how your capital is composed, like the front office or the traders. They want to see how their particular product, if they trade it, how it would affect the capital charge. And this is only like possible really if you can have good capabilities here. And so what with our approach, what we would get, we get really like faster computation time, and it's like independent of the technology used. And we can we compute basically our capital charge once, and it's disaggregated at like trade level, and then you just can add it up together. And whereas in the normal implementation that we see, that's like not possible. Like going back like to the CRR1 like from 2013. So that's mostly kind of linear thing. Like when you aggregate, you can easily break it down. But with the FRTBs, that's not possible anymore. So that's like it's an important kind of feature to be able to do that. And then what kind of challenges? And the other thing was the with this decomposition, what we can do like on the fly recomputation. So you can do what if for hedge analysis. And so for example, if you plan like due to the LIBOR reform, if you want to switch from Euribor to reformed Euribor and just book a new trade, so how would that basically affect this? So this is something and some analysis you want to run, and this could be also run very easily with that kind of setup. So the LIBOR reform will be in the next talk. It's just to give you an example. Now, can you keep the previous slide, please? Yeah. So, and then from what kind of challenges we see typically with the implementation of FRTB. So the first one is the decomposition of funds and indices. So these need to be decomposed, and when you have a fund, there's often the data is not available. And it's difficult then to aggregate it, and as fund of funds is a kind of challenge here. Then the other thing is the curvature numbers. So especially that's for like more complex instruments. So FRTB requires some large shock of the risk factor, and the pricing models need to be able to compute such a shock, and that's often like a challenge that we see at client. If you have a less complex portfolio, most linear, then it's kind of less of an issue. And again, like this reference data is key, because there's this bucketing happening, and it's really important to get the reference data right. So to give you an example from a client, so a client was delivering in the commodity bucket. So they're delivering once aluminium and the other was aluminium alloy. And this is just because the data was set up like this, and this produced like a large capital increase. But it's basically the same thing, so that they could basically match it and reduce the capital charge by that again. It's just a kind of a data issue, what can have big capital impacts. And then especially what's interesting for Eastern European countries, which have like pegged currencies or which are closely tied to the euro. So in the CRR, there's the concept of these closely correlated currencies, which under the CRR2 or FRTB, such a concept doesn't exist. So this might go away. Also, there might be still some preferential treatment, but that's under discussion. But as it's the text is now, and they don't have a preferential treatment. So now let's go to the next slide, to the capital analysis. I give you maybe some example here. So on the top left, so here you can see the capital broken down by different desks, and so the red ones are where there's a large capital. So under this current contribution, so the capital is like low, like 186, but under the standardized, it rises like eightfold or something like it to 1.4 million, so a huge increase. And so people wanted to know why this is happening. And then with our kind of feature, we can then drill down into the standardized approach. This is the box on the lower left. So there we drill down this large number 512. We drill down, and then we see that it's from the standardized component on the curvature is 919. And then we drill down further, and then we see that it's like caused by the currency euro. So that was the big driver. So with our kind of methodology, we can really present the data as additive numbers, and then you can easily, like using pivot tables, to drill down in a kind of granular level, and then you see immediately where your capital increase is coming from. But whereas if you just would implement like the regulatory text, it's really difficult to drill that down. So this methodology makes it decomposes the capital in ways so that you can easily drill down and look at it. For that methodology, so we have implemented this at we have developed that basically in-house and implemented at 3 global investment banks. So they're using this kind of methodology, and it's really like a business. So the front office, the traders, they really like it because they really can drill down easily to trade level and see what causes the capital, what drives the capital, and basically that goes down to the trade level. And yeah, so that's this capital bit. And we also have calculators for that, and that we can share. So we have different technologies for that, like in Excel, in Python, but we also have a calculator in Hadoop and big data. So we have currently several in-house developed calculators with different technology that we can bring to clients, basically. And finally, we have a survey on the next slide. Yeah, so here's the for the aggregation algorithm. Do you use any simplifications? So are you using this correlation matrix and the formula is in the regulation, or are you using simplifications? So are you using like a single loop to reduce computation time? Are you producing additive contributions for pivoting? And then others do not know or know. Okay, thank you. Then the result. So that's good. So we have a few using this kind of optimization algorithm already. So there's a lot of improvement, so that can be used for others as well. Okay, thank you. Then the next questions here. So which capital allocation methodology do you use? Standalone pro rata approach. Yeah, and then marginal, incremental, other, or do not know. So these are the first three, like kind of three standard approaches. So that's the methods, basically how you decompose your capital, because due to this correlation aggregation, you can't add it like additively. So it requires some of approach how you break down or allocate your capital. Okay, so do we have that one? Yeah. Okay, so the majority uses the standalone pro rata approach, and some use incremental. And yeah, so we would propose basically the third one approach, because the first one, standalone pro rata, doesn't really give you doesn't take into account like some portfolio effect. So that might mean like if you add a product, it doesn't. If you buy a new product which as a standalone increases the risk, but overall might decrease the risk. So that's kind of challenging with the first, because you don't have the view how it is what's the portfolio effect on that one. And then the next question. So what analysis and drill down capability do you have? So you have trade level risk and data drill down, capital contribution at trade level, what if and hedge analysis, standalone aggregated capital only, and do not know. So there are multiple answers you can give here. So all of these are basically kind of business requirements, especially the front office might have if they want to trade, or if you want to analyze what to do with hedges, how you can improve your hedges, or if you want to analyze your risk, and that's like typical business requirements, I see. So what results do we have here? Okay, so there's some have the trade level drill down, but very few have only the capital contribution or at trade level. So there's like room for improvement. And as I mentioned before, the standalone aggregated capital only, it will produce like one single number that you can then send to the regulator. But for ongoing kind of business operations, we see so many stakeholders want to understand how the capital, how this number was produced. So then there's these other capabilities are typically being added to that. And then let's move on to the final question. So which areas of your target operating model are most challenging? So the first word, impact of standardized approach on existing process control service level agreement, resource forecast for different function like risk, front office, reporting, and then the approach to parallel run. So how will you run the FRTB, and so the CRR2 and the CRR in parallel for the next years. Technology, is that a challenge? Or the next one is the capabilities for capital allocation and analysis. So what you can also answer several here. So what are your are your biggest challenges here? Okay, so what results do we have? Okay, so the impact on the existing processes, controls, and service level agreements is big. And yeah, the parallel run seems to be less of a concern. But interestingly, the biggest one is technology. So which technology should be used for that one? Okay, so that's where the results are. Now we might go to some of the questions that we have proposed here. So the first one is so you ask like our FRTB solution, whether it's independent software or whether it's based on R or statistical software. So the solution that we have is all internal developed. So there is no like additional license. So the first solution that we have is Excel based. Then the second one is based using Python, because that's typically faster. And the third one, so we have developed like to mimic what basically the banks do, or to mirror what the banks are doing. So we have basically built the big data aggregator. So that's on the cloud already, and that's using Spark, Hadoop, so big data technologies, and also front end from React. So that's all like open source software, and we can deploy this for clients. But this big data is really we have seen it for the larger investment banks. It depends, like for smaller, it's not really necessary if there's not the data amount. But this is basically the three options that we have. Yeah, then there was another question on the whether for the risk weights one can use the expected shortfall 97.5% or 99.9% for the risk weights. So this is the risk weights are really prescribed here for the standardized approach by the regulator, so they can't really be exchanged by internally computed one. So this would be then just subject to internal models if you want to run internal models, but for the standardized approach is really prescribed by the regulator. Yeah, I think that's where the most
perhaps
questions.
You know, Thomas, two questions that come to my mind, more general one. Let's say, as you saw the results of the survey among our participants, can you you know, give us some kind of a background? What is the London landscape? How advanced, you know, are London banks, and how different, let's say, we are here in this part of Europe?
Yeah, okay, sure. So from the survey, I was a little bit surprised that like I think half of the respondents have not started with FRTB, because it's really like less than 10 months away. So what we have seen in London really, because I think the majority of trading books are in London. So the banks here in London are mostly like trading book focused, and they had already run like big implementation programs back in 2015. So they are basically, so I guess they were already operational like 2 years ago with the standardized approach, because they're sometimes really trading only, and so this is like really crucial. So that they have been fully operational with target operating model testing and so on, like 2 years ago. Well, what's currently in a discussion in London is more like how to get ready for internal models. Because that's still under this discussion, and but for the standardized, they mostly have been ready like a few years ago, right? Just because it's just so business critical for them with this big trading operations.
Okay, and based on your observations, what is, let's say, the change in the capital charge which arises from the standardized approach? What could we expect?
Yeah, so that's a good question. So when you look at most of the surveys, they are mostly conducted for internal model banks. So then these compare the old internal models to the new internal models, and they always have been significant increases for that. But I think what the banks here in the panel are most interested, like, is going from the CRR to CRR2. So from the CRR standardized to the FRTB standardized approach. So for that, there is a survey from the ECB, so specific for that purpose, and there was a median increase of the capital of around 50%. But what we also observed, or what the survey also observed, is really not homogeneous. It's really heterogeneous. So in this survey, actually, the capital impact is from -80% to 200% increase. So it's really quite broad. So it really depends on the business model. We also have had some surveys in 2018 and 2019. So the older surveys have like a more capital impact, but the more recent one, it's going down a bit, because like FRTB has a little bit changed, so it's going down a little bit, but still in our survey we got like either the capital stays like similar like it is what now, or ranging to like 50% increase. So this is what most of the banks, what we see in most of the banks in the terms of change for the capital from the CRR to the CRR2, basically.
Okay, thank you very much. So right now we can turn to the last part of the presentation, and let me briefly guide you through the changes that we will observe due to the IBOR reform. If we can go to the next slide, please, and the next one. Yeah, so before we will go into details, just let me perhaps try to shape the landscape before the reform. So I will start with giving you the details about what actually index and benchmark is, just to be precise later on during the presentation. So index, this is basically a definition according to the benchmark regulation, so the EU regulation. This is any value, any figure that is published or made available to the public, and is determined by a formula, and is determined based on some kind of an underlying asset price, or let's say indication from the market. And in particular, the interest rate benchmarks, we should call them benchmarks, because actually interest rate benchmarks determine the amount that is payable in the financial contract. So not only, let's say, the index, but also the benchmark. Benchmarks are known for many years, because they are published, that they are made available for nearly 50 years right now, on one hand. On the other hand, before 2012, they were delivered, they were observed by the benchmark administrators, who usually was connected to Bankers Association or Market Association or Dealers Association. So basically, it was the initiative of the sector as such, and not controlled by the regulator. If we can please go to the next slide. The situation changed actually due to two factors. The first one was observed during the financial crisis, and it was the diminishing market for the unsecured transactions on the money market, which constitute the basis for most of the, let's say, calculations of the benchmarks. So as you see, starting from 2008, we observed smaller and smaller number of transactions on this unsecured market on one hand, and the graphs on the right hand side based on the ECB statistics for the money market and recent issuance of the report coming from 2019. Actually, if you go into details, the volume of transactions that really could be based on to determine benchmark is even narrower, because basically not all the transactions which take place on the interbank market could be taken into consideration. That there are usually certain, I would say, thresholds or minimum levels that must be kept, both in terms of value of the transaction and in terms of timing of the transaction and when it appears. So the real data that is available to produce to determine the benchmark is even more limited. But unfortunately, this is not the only observation that led to the whole reform. If we can jump to the next slide, please. We also observed during the time between 2005 2007 number of market manipulations for the banks that contributed to the LIBOR, and basically this led to the investigations run by many most important regulators about the situation, just to clarify whether and to which extent the benchmarks were manipulated. And actually that turned out that at least the LIBOR benchmark was, let's say, manipulated by the contributing banks. And this was one of the biggest financial scandals earlier before 2012. This also led to issuance of the guidelines for regulators and also for contributing banks, how those benchmarks should be, let's say, reformed and in which direction it should be changed. The first guidelines were issued on the British market by the British regulator, and it was in 2012. Then, starting from 2016, we also have the European Union regulation, which is called Benchmark Regulation, which comes into force starting from 1st January 2018. And basically, starting from 2018, we observed the first elements of the reform, which was, for example, setting up the independent administrators, so the entities that are responsible for calculation of benchmarks, and also putting appropriate supervision over them by the local regulators. Right now, we have the last, let's say, phase of the reform, which is withdrawal or discontinuation of the LIBOR, which I will talk about on the next slides. So if we can please move on. Before going into details, just please understand that the reform is quite complex because it doesn't reflect one market, and it doesn't reflect, let's say, the situation for one currency. It also requires involvement of many regulators. So what I'm trying to do on the right hand side is to point out the most important participants, starting from the working groups. So working group is basically the entity constituted by usually the central bank or all the local regulator, together with the institutions, financial institutions active on the financial market, where all the discussions about the transition takes place. We have, let's say, different working groups right now set for all the major currencies, and also speaking about Central and Eastern Europe, for all the countries that still have independent currencies, similar talks are right now taking place. The second important group of, let's say, participants in this discussion are index administrators. So actually entities, bodies that really puts together all the market information and are responsible for publishing indexes. They are supervised by the local regulators, and basically those local regulators approve the methodology for calculation of the benchmarks. As the main important idea of the reform is to the level possible based on real market transactions, there are of course very important input from the market, so from the buy side, and demand from the buy side for the products based on the RFRs actually also build this market. We have also quite important elements, quite important participants from market associations like ISDA, because they are responsible for putting together the rules and let's say the most important framework, including also the regulatory and agreement framework, how the counterparties for the reformed rates should behave. And last but not least group is clearing houses. So clearing houses, at least here in Europe, in most of the cases, already transferred to the reformed rates. And right now they use RFRs instead of the old interest rate benchmarks. So let's move on. And basically, here you see the most important working groups that are constituted around the world and that are responsible for guidelines how the local transition should look like. I will not perhaps go into details, just to leave it for further, let's say, self-reading. But on the other hand, this is the most important right now source of information. What happens with certain currencies and what happens with certain group of products, because this is the first level of preparation for the recommendations, at least. And right now we expect that those recommendations from the working group will be transferred into the legal systems, into all the countries that are mentioned. Actually, on the next slide, we also could see the information about the most important assumptions of the reform. So the most important underlying ideas are as follows. After the end of December 2021, we could expect that the LIBOR interest in benchmarks will be discontinued. And right now, this is quite clear that this deadline is, let's say, to be kept, no matter what is going on the market currently. I mean, the COVID restrictions and, let's say, delays in perhaps other work streams. We know that this December 31st, 2021 will be most probably the date of this discontinuation of the LIBOR rates. The second point refers to the working groups, and basically working groups already prepared and published the overnight indexes for most important currencies. So right now they are available to use. For additional currencies or for additional indexes, like for example EURIBOR in particular, we already have, let's say, the EURIBOR reformed, and we already have the situation where EURIBOR was, the methodology calculation for the EURIBOR was modified, and right now it's declared to be fully in line with the BMR requirements. And on the other hand, there is also ESTER as the alternative risk-free rate for the Eurozone market. Basically, the financial institutions, together with the working groups, started the preparations and right now are in the, let's say, preparatory phase for the change. This preparatory change has, let's say, also the regulatory targets which are defined, and most important, regulators defined end of June 2021 as some kind of a target date by which the new products at least should be transferred to the risk-free rates which are developed right now. And perhaps last comment, which brings another, let's say, point, quite complicated point in the whole discussion, is that although we have quite many developments right now, we still miss forward interest rate and the forward curve. So basically, this is one of the most important areas right now which are being developed. And this is one of the most important, let's say, areas where the banks and also other institutions like Refinitiv or Bloomberg are working on. So right now we can move to the next slide just to briefly describe what we should have instead of, for example, LIBOR rates. So I mentioned the alternative risk-free rates, and basically for the main markets, they are right now available and they are prepared. But except for the, I would say, plain alternative risk-free rates, we also have compounded risk-free rates. So, for example, compounded based on the historical data for last 30, 60, 90 days. We also could have some additional indexes, like, for example, average index. Average index was made available, for example, for SOF. It's different index to the overnight, let's say, plain RFR, and it's treated as additional interest rate benchmark, which could be used, for example, for the retail contracts. And last point refers to the forward-looking term rates, which we are still, let's say, missing and which are still being in the development. We could go to the slide number 45 directly, and the next one. Just to summarize, let's say, the transition rules and summarize what's going on the certain markets. So in the Eurozone, we have right now two interest rate benchmarks which are available. The primary alternative risk-free rate, which is ESTER, which is being produced and published starting from the last year, and basically right now is available for the use in contracts. We also have reformed EURIBOR. I mentioned that the EURIBOR was changed to adjust to BML requirements, and it's right now available. For the British market, we have the, let's say, expected by the local regulator shift from the British pound LIBOR to the new reference rate SONIA. For the US market, we have the defined SOF, which is slightly specific in comparison to the other benchmarks, because basically it's based on the secured transaction, it's based on the repo market. So in this way, it's really risk-free because it's being collateralized. And out of the, let's say, main currencies, the last one is SARON. SARON is produced for the Swiss market, administered by the Swiss exchange. And on the other hand, it's been defined as the transition rate for the exposures, which until now were based on the Swiss franc LIBOR. Okay, so we can move on. On the next slide, I just briefly put together the information about the indexes for the Central European countries. I leave it, let's say, to you. The information is actual. However, let me not go into details for the other markets, because basically we can observe that we have specific situation on each of the markets. So let's not go into details. But definitely where we need to go into details is the slide 47 exactly. So basically the recent developments and also regulatory challenges. Over this year, over 2020, we observed that the clearing houses, the main clearing houses, switched already to the reform trade. So, for example, for Europe, this switch took during the holiday time, and right now this clearing house, the most important clearing houses use Esther as, let's say, way of calculating the collateralization of transaction. On the other hand, we had number of important developments of the British market. So starting from the end of first quarter 2020, there was an expectation of the British regulator to start concluding transaction based on RFRs, based on SONIA, on the derivative market. So the swap transactions right now, the majority of the swap transactions on the British market is concluded based on SONIA rates. This is a very specific situation because I think in these terms, British market is the most advanced. Also, very important deadline was put for the end of first quarter 2021 because the British regulator expects that all the new loan products should be based on the SONIA and not on the LIBOR. So basically, this is quite important transition date. And very important series of events or series of declarations took place just last week on the 18th November. So on the 18th November, the British Index Administrator, ICE, announced that it starts the consultation on the discontinuation of the LIBORs for most important currencies. It was followed by the declaration of FCA, so British regulator. The British regulator will not support further preparation of the indexes for Euro and Swiss franc. And it was also followed by the declaration of the American working group that also the American confirmed they will to switch to the RFR, which is dedicated to USD market, and basically not use LIBOR anymore. So if we go to the next slide, there are a few more details which are put together. So also for the US market, already we could observe the switch of the central counterparties to the new reference rate. And also for the US market, we have the information about the target date. So basically, expected date when the financial institutions are requested to finish sale of the new products based on the LIBOR and switch to the RFR. And this date was set for the 30th of June 2021. On the other hand, in Switzerland, we have also quite important developments because right now we could, let's say, observe the recommendations for the most important products, what kind of interest rates should be used for certain group of products, but also quite important in terms of, let's say, so-called tough legacy products. Very important declaration, especially for the countries here in Central Europe, that Swiss regulator do not see the problem for the tough legacy contracts. So basically do not see the problem of the portfolios which in the past were sold and combined with the Swiss franc LIBOR. So basically, they are not going to produce any further guidelines how to solve this problem, as they think this may not be the case for the Swiss market. So basically, all the Swiss portfolios that still exist, and there are some, including the Polish market, where this is quite substantial problem. We are slightly left alone with the regulators without, let's say, the guidelines of the Swiss regulator here. Okay, so I think we could move on. And on the last two slides, I just wanted to show how the market is developing and what is the volume of contracts right now. So basically, perhaps let me start with a very general comment that the whole market based on the RFR in terms of derivative transactions is not huge, because it's about 7.6% of the global market in terms of trading volume. But it's not spread over all the markets evenly. I mentioned that over 50% of the volumes right now for the British market are based on the reference rate, so based on the SONIA, while on other markets those shares are slightly smaller. And I would say that in Europe, in the Eurozone, we observe, let's say, the less advancement in this area, and the share of the Ester instruments is quite limited. If we can go please to the next slide, and next markets through. So on the next slide, you could see the information how the bond market is developing. Actually, we have quite dynamic development of the bond markets based on SOP, so on the US RFR. And during 2020, we already observed over 100 billion of such issuances, and we observed 72 issuances of the bonds based on RFR. On the other hand, if we compare it to the European RFR, so Ester, we could see that the development here is definitely less dynamic, and the changes are not taking place that dynamically. Okay, so right now we can go to the next slide and the poll question, which is over there. Yes, I wanted to ask you to share your point of view about, let's say, level of preparation. So basically a question, did you start the works related to the adoption of the changes resulting from the IBOR reform in your company, in your institution? And I will give you a minute for putting together the answers. Okay, can we see the results, please? Okay, quite optimistic, I would say, because 45% of respondents already started the work. Another 50, let's say, declared that until now it was not started, but there is a plan to start it in the future. And only 4%, let's say, of our attendees right now declared that it doesn't affect the certain institution. Actually, I say that it's very optimistic because when we ran similar poll during the springtime in Poland, we received only below 10% replies that the works were already started. So definitely what is seen here is more optimistic. Okay, so let me come back to the presentation just for a while with the last slide about the most important areas of the impact. So there are, let's say, 4 areas which I think are the most important. Starting from the risk management area, there is definitely a need to develop the yield curves based on the RFRs, and the whole, let's say, change in the forward rate curves and the yield curves. This is quite a huge challenge for the individual banks, taking into account that, let's say, this market is still under development. So this is the first challenge. The second challenge actually is connected to changing of the valuation models, but changing also for the models for the risk management. We had questions and we had a presentation about interest rate risk management, and actually both three topics that were covered today intervene somehow, because let's say the interest rate risk management in the RFRs also should look differently in comparison to what we have until now, especially that most of the models for the new products are not suitable, so they need to be redeveloped and they need to be revalidated, which takes a certain amount of time. A totally different element of the risk management is liquidity management, because basically right now all the issuances were based on the, let's say, traditional interest rate benchmarks. The market, as we saw for the bonds based on the RFRs, is developing, and definitely this is a question how to structure the liquidity of the institution and how to approach that, taking into account also own issuances of bonds and funding. The second area that is definitely affected is accounting area, because I already mentioned change in the valuation of financial instruments, and basically this is the fact. Another huge modification or another huge area of work is hedge accounting, because what we could see in the hedge accounting is, let's say, the question whether the hedging instruments, so the derivative contracts and the loans which are usually being hedged, whether they will behave in the same way in terms of transition through the reform, and if not, this may lead to the need of discontinuation of the hedge relation, or at least reassessment of the effectiveness. The next area is legal and tax area, because basically I try to concentrate, let's say, on the market risk aspects of the reform, but we should remember that the reform brings also huge challenges with regard to changing of the contracts with the clients, both for the derivative market, but also for the banking book contract. So basically, for the customer loans, and definitely this is huge challenge in terms of defining the proper relations, taking into account all the developments. For the tax area, there is definitely a transfer pricing documentation which needs to be adjusted, and there is also a result of that change in the valuation which could affect taxes. And last point here on the slide, this is the operational area and the system area. And basically, I remember, let's say, my discussions with some of the banks from Western Europe and some of the banks which are classified as globally significant. And my question about their readiness for the reform and, let's say, the challenges they face, the answer was quite straightforward. So it's not the question whether to start the work, but how we could do it efficiently in terms of changing the IT systems. And I believe this is still the area which requires, let's say, the most attention, at least from the experience which I have. But let's say I don't want to base on my experience only. I wanted to jump to the next poll question and ask actually about also your experience in this area and your expectations. So the next poll question refers to, let's say, refers to the areas that you think are the most affected by the reform. And if you could please share your point of view, I would be grateful. Okay, can we see the results now? Okay. Core business activity as the main area, yes, definitely, including all the also legal challenges around that. Risk management as the second most affected area, definitely huge work ahead of us. Accounting, reporting, and legal on the next, coming next. Okay. So as the time is passing and being aware of that, just let me ask you for any last questions, last comments from your side. Okay, I don't see anything. So thank you very much for your participation today. Thank you very much for the opportunity to present those three most important elements in the market risk space. And I hope we'll keep in touch in terms of all the questions. You will find the contacts to all the presenters for today. So if you have any unaddressed questions yet, please contact us directly. Thank you very much for the meeting.